When it comes to investing in dividend stocks, you typically have two options to choose from. You can either invest in stocks that offer lower yields at around 1 to 3%, such as McDonalds or Johnson & Johnson, but can offer share price growth as well as potential dividend increases. Or you can invest in stocks that offer much higher yields but don't offer much in terms of dividend increases or share price appreciation. One example of this would be a company like Gladstone Commercial Corporation, ticker symbol GOOD. As you can see, since their inception, the stock share price hasn't seen much action in terms of share price growth, nor have they increased their dividend by more than a fraction of a penny since 2008. Now, this isn't necessarily a bad thing in this particular situation. For one thing, this stock does pay monthly dividends, which is great for people like myself who are more motivated to invest in companies for monthly dividends as opposed to quarterly dividends. It's also the kind of stock that people who are retired might be interested in, since because of its flatlining share price does offer more stability than your more typical growth or technology stock. So there are lots of good reasons to own stocks that have been able to provide high quality yields with stability. But as I like to say in my videos, no matter what stage of life you're in or what investing strategy you're pursuing, you should always dedicate some of your investments to things that provide growth. It'll help accommodate for rising costs since the average inflation rate in the United States has been around 3% over the last 100 years. So today I thought it'd be a good idea to take a look at some of the stocks in my portfolio that offer both high dividends and have offered share price growth and dividend growth since each stock's inception. While there's no guarantee these stocks will continue to grow, everything that I've looked at seems to indicate that it's possible, but it's never guaranteed. So with that being said, let's go ahead and get started. The first company on this list is W.P. Carey, ticker symbol WPC. This is a real estate investment trust that's one of the largest diversified net lease REITs specializing in the acquisition of operationally critical single-tenant properties in North America and Europe. For nearly 5 decades, this company has invested in high-quality single-tenant industrial, warehouse, office, retail, and self-storage properties subject to long-term net leases with built-in rent escalators. In addition, this REIT is also a triple net lease REIT, which means that the tenants are responsible for covering maintenance and taxes. Right now, their stock offers investors a 5.09% dividend yield. They issue dividends quarterly, with their last being for about $1.06 per share. The stock is actually slightly up for this year, as you can see. It's currently up 2.34% as of the making of this video. If we expand the share price performance of this REIT since their IPO, it's pretty clear that this company has been pretty well managed. There have been a few periods like between 03 and 08, as well as 2013 to 2018, where there wasn't much share price growth, but this company has grown their dividend every year for the last 24 years. If this company continues to perform as well as they have been, then they'll become a dividend aristocrat next year. Looking at their portfolio, there's a few things that I think are really worth pointing out here. As of the first quarter of 2022, their occupancy rating is 98.5%, which from my experience is higher than average among REITs, and they have a weighted average lease term of 10.8 years, which is really exceptional. This means that the average tenant renting a property from W.P. Carey still has over 10.5 years left on their lease. This is a good indicator that profits for the company should be really stable for years to come. I've seen some REITs that only have a WALT of about 4 years, which can make things a whole lot more uncertain, but 10.8 is probably one of the best I've seen. W.P. Carey is pretty well known for having a real estate portfolio that's a lot more recession-proof and defensive than others. In their latest investor presentation, about half of their portfolio is made up of industrial and warehouse properties. They also have a lot of properties that tend to fare better during economic downturns. A sizable portion of their real estate includes self-storage properties, government offices in Spain, as well as K-12 schools in the United States. Finally, when going through their financials, I'm seeing plenty of good things, but there is one thing that I'm concerned about. Adjusted funds from operation, which in my opinion is one of the most important lines in the income statement for an equity REIT, shows continuous year-over-year growth for rental income. But another important metric for a REIT on their balance sheet is their book value, which is currently $39.99 for this company. This means this stock is currently trading at a pretty sizable premium, and considering it's currently trading near its all-time high, I honestly think that it's currently overvalued a little bit. Now, a REIT trading at a premium to its book value isn't a bad thing if there's a lot of growth, but their book value hasn't seen much growth over the last few years. Plus, the fact that it's going to be a dividend aristocrat soon is another good reason why this stock is trading so high. I could be wrong, but right now I'm not buying any more shares of this company as I'm hoping the share price will fall just a little bit. This next stock is Hercules Capital, ticker symbol HTGC. Hercules Capital is a business development company that provides venture debt, senior secured loans, and growth capital to privately held venture capital-backed companies at all stages of development. They generally seek to invest in companies that have been operating for at least 6 to 12 months prior to the date of their investment, and they like to target the technology, sustainable energy, and life science sectors. Hercules likes to make investments between $10 million and $25 million into each company they provide financing for. Their stock currently offers a very sizable 9.1% dividend yield according to Google, and they pay dividends on a quarterly basis. Right now their share price is down about 12.5%, which isn't as bad as the S&P 500, which is down over 17.5% for the year. Since their inception in 2005, their share price has grown by a really impressive amount for a BDC. Up until 2022, when the market took a downturn, Hercules stock's share price actually had grown by over 31% since their IPO. It's still currently up over 14% since their inception. You can also see they've been able to increase their dividends over the last decade, and they also pay a special dividend every now and then, which is really nice. Some things that distinguish Hercules Capital from other BDCs include having a debt portfolio that's made up of 94.7% floating rate loans. This means that as interest rates rise, this company will earn more money from their debt portfolio, which can mean more revenue for the company. At the same time, however, it could also mean that more companies could potentially default on their loans, so it's not always a good thing. But I think given this company's track record, this should be a good benefit for them. They also don't invest in oil, gas, metal, or mineral companies, which are sectors a lot of BDCs tend to avoid given how volatile they tend to be. As previously mentioned, their investment portfolio is largely in the technology and science sectors, with drug discovery and software making up the largest portions of their debt. Some of their most well-known investments include companies like DoorDash, Lyft, 23andMe, and Impossible Foods. Their science investments are also pretty interesting. A lot of these companies produce treatments for cancers and other diseases. There's also a lot of green companies in their portfolio that operate in the sustainable energy and renewable technology sectors. Hercules Capital is also an internally managed business development company, which is another thing that I like. When it comes to BDCs, there's basically two kinds of companies. You've got internally managed and externally managed companies. The main difference is externally managed BDCs, such as Prospect Capital, hire a different company to manage their investments for them. This usually translates to higher fees and can result in fewer returns to shareholders. But not all externally managed BDCs are bad though. One I like in particular is Triple Point Venture Growth, but I do prefer internally managed ones. Hercules Capital's net asset value has also been moving upward over the years, which is a really important metric that shows management's been doing a great job in growing their company up to this point. The third high-yield stock on this list with both dividend and share price growth over the years is Ares Capital, ticker symbol ARCC. This is also a business development company that specializes in the acquisition, recapitalization, restructuring, and leveraged buyout transactions of middle-market companies. Ares Capital typically invests between $20 million and $200 million in companies with an EBITDA between $10 million and $250 million. This company holds first and second lien debt, as well as subordinated loans and preferred equity. Ares Capital was launched all the way back in 1997, making them one of the older business development companies in the industry. Their stock also offers investors a very high dividend yield of 8.59%, and they issue dividends on a quarterly basis. Since their IPO back in October of 2004, the share price of ARCC has grown by more than 27%. Actually, before 2022 rolled around, their total share price growth since their inception was over 38%. While this company did have to cut their dividends during the 2008 financial crisis, they've been able to grow it consistently, all the while offering an occasional special dividend every now and then. As I mentioned several times before, Ares Capital is my favorite business development company out there for a number of reasons. They're currently the largest BDC in the industry, and as I like to say, when it comes to BDCs, size definitely matters. Up to this point, they have a really long history of delivering great returns on their investment portfolio of debt. Their portfolio is well diversified, and they hold a lot of senior debt, which is considered to be the safest kind of debt, but it's still not entirely risk-free. As of March 31st, 2022, Ares Capital's portfolio had a fair value of approximately $19.5 billion and consisted of 395 portfolio companies backed by 201 different private equity sponsors. It's resulted in an annual share price return of 13.5% since their IPO, which if you haven't included this year so far, this number would actually be a bit higher. This graph on their website shows the cumulative core earnings and their net realized gains along with their cumulative dividends declared. The next stock with impressive growth and dividend increases is Main Street Capital, ticker symbol MAIN. Main Street is a business development company that specializes in equity capital to lower middle market companies. They provide debt capital to middle market companies for acquisitions, management buyouts, growth financing, recapitalizations, and refinancing. They invest in a wide range of different sectors, including IT services, machinery, healthcare equipment, construction, among many others according to their website. They typically invest in a range of $5 million to $50 million per transaction in debt investment value. Main Street has a really great history in terms of its dividend distributions. Not once throughout their entire history has this company ever had to reduce their dividend. This is a company that went through the 2008 financial crisis and the COVID pandemic and yet never had to reduce their dividend. This is unmatched by almost every other BDC out there. But Main Street has been able to maintain their dividend all these years as well as grow it and pay out the occasional special dividend to shareholders. There's no guarantee that they'll never cut it, but so far they have an excellent track record. Their debt investment portfolio is one of the best in the industry in terms of diversification in my opinion. They're invested in a lot of different sectors from software to aerospace to construction and others. They are invested in some sectors that I don't particularly like, including hotels and fuel companies, but these investments only make up a very, very small percentage of their overall portfolio. Most of their investments make up less than 1% of their income, which again is great for diversification. Another really cool thing about this company is that historically speaking, Main Street is a stock that's been able to outperform the S&P 500 by a pretty sizable margin. Going back 14.7 years, which was when Main Street had their IPO, a $10,000 investment into MAIN would have significantly outperformed the exact same investment into an S&P 500 index fund, whether or not you chose to reinvest your dividends. There's actually a number of high-yielding dividend stocks out there that have outperformed the S&P 500 quite a bit, with Realty Income and Ares Capital being a couple others. And I know this is all historical data and we don't know what the future holds, but knowing this gives me more confidence in this company's management. Looking through their financial statements, we can see a lot of really positive things going on with this company. Because Main Street Capital tends to invest more in equity than some other business development companies, it's allowed them to grow at a much faster rate than most other BDCs. Although holding more equity investments is riskier than senior secured debt, the management team over at Main Street has been doing a pretty exceptional job up to this point. But we can see a long ongoing trend of increasing book value, which as I mentioned before is probably one of the most important metrics when analyzing a BDC. So overall, I continue to be a pretty big fan of this company, and I've been very impressed with the returns I've gotten up to this point. And that's going to conclude our look at some stocks that offer a mix of both high dividend distributions and increases in share price and dividend distributions. Feel free to leave a comment below if you happen to own any of these stocks in your portfolio. As always, as I like to mention, be sure to do your own research and perform your own due diligence before investing in any of these companies. Don't just buy the same stocks I'm buying unless you come to your own conclusion after doing your own research. Also remember that dividends are never mandatory and they can be cut or eliminated if the company needs to. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below and also subscribe to the channel if you want to see more high yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. Alright, thanks again guys so much for watching, and until next time, take care.